Are you having trouble getting your contract accepted to buy a house because your current house hasn't sold yet? I have a solution for you. 2 ways that you can fix this problem. Easiest way, number 1, get a home equity line of credit against your property. They are free. You get them through your credit union, your bank, any of those. How that works is, let's say you have a home worth $600,000 and you owe $200,000. There's $400,000 worth of equity there, but you can't use it. It's just sitting there. It means nothing. Get a home equity line of credit. They're free. They give you a checkbook. The credit line is open to 80% of the appraised value taken at the time of application. So if your home's worth $600 and you owe $200, you can borrow 80% of that minus the $200 as an open line of credit. There are 0 payments on it, and typically you have to keep that for 3 years or they will charge you back closing costs. For example, if you take a home equity out today, but then sell your house a year from now, there were no closing costs when you took out the home equity, but when you sell it, they're going to charge you a prepayment penalty with those closing costs. That's option number 1. Option number 2 is what's called a bridge loan. A bridge loan will be a loan that they give you on your property when it's listed for sale. If it's listed for $600,000 and you owe $200, they'll give you up to 75% of that new list price. So if you listed it for sale for $600,000, they'll give you 75% of that. They will pay the current payment on your first mortgage that you owe. They'll include that in the cost. So they'll write checks to your first mortgage company. So you're not responsible for 2 mortgage payments. Then they'll give you the cash out that you need. You can take that loan and the cash that you need. You won't have to put a contingency on selling your house because you can buy the new house using the equity of your old house. It's pretty simple. There are closing costs. They equal about 2.25% of the list price. So it sounds expensive, but option number 1 has interest payments. Option number 2 does not. So by the time you equal out the payments that you're paying on the home equity versus the payments or the cost that it costs you for doing the second option, the bridge loan, they almost are the same. So if you have a lower credit score, go with option number 2. If you have a higher credit score, go with option number 1. If you need help with this, let me know. If you're in this situation, follow me, subscribe, push this to your friends, DM me. If you're in this situation, I can help you. We can make it happen. Thanks.